Missed the big move on day one? Listen, it happens. A lot of you guys are part-time traders. It's tough to watch the market all the time. But you got home from work or you sat down at your computer, your phone, and you see these big gainers. Oh, I missed it again. Don't sweat it. At the end of the day, most traders, there's so many stocks that move every day. You can't watch them all. You can't trade them all. But don't give up is my point. When you see that big move, it's not too late, okay? Here's the truth. Day two and day three can offer some of the best setups. And what's great is since it isn't a stock just spiking out of the blue, you can actually be prepared in advance. A lot of people fall in that trap of constantly watching the market because they want to catch those moves. But then you're at work, you've got things, you're with your family, you got things going on. You simply can't catch the first leg of that move. But what's great about day two and day three moves is you can run those scans at night, maybe in the morning, and you can now map out a plan for that continuation play. Now I know you're gonna say that gains aren't as big on day two or day three. It's fine, okay? Sure, you see these 300% runners, the odds of it going another 300% on day two or three are low, but let me tell you something. Remember, risk and reward are tied together. They're bound at the hip. So the higher the risk, the higher the reward. Then lower risk, lower reward. I'm sure you automatically keyed on lower reward, but think about it, lower risk. So if you're constantly getting stopped out on day one, you're chasing only to have it dump, the moves are smoother on day two and day three. And what I love about it, particularly for new traders, is you can be ready in advance. You don't have to be there at the precise time of the move. Odds simply state, especially when you're a part-time trader or you're new, you're just not going to be there at the beginning of the move. So quit trying to catch them. Run your scans at night, look for those big gainers, and map them out just like this. So I'll show you how I trade these day two continuation plays, what I look for, what to avoid, how to time your entry without chasing. So let's break it down. Now, the reason day two plays matter is because you've got that follow through type situation. So now let's go back to, we've got day one, that big spiker. You were at work right here, okay? You were commuting, you were with your family, you missed it, so be it. But what we want to see on day one is that strong close. Now, that doesn't mean it has to spike into the close. What we want is a close, and write this down, at or around the highest point of the day. Now, many of you know, especially in these volatile stocks, most of them do this at 4 p.m. Usually about 2 p.m. is kind of the breaking point. If a stock is gonna spike into the close, it typically does it around 2 p.m. If it doesn't spike at that time of day, that's when you get that scenario. Now, those are the stocks you ignore. You don't care. When you're running those scans at night, you're gonna ignore these. The stocks that fade off or even fall apart at the close. One thing I wanna take a quick segue into, and this is key to this idea of multi-day continuation plays. The trend into the close is most likely going to continue the next day. Now, what that means, we don't fight the trend. Whether you might have heard of trend following. Michael Cavell's got a bunch of great books, but you might have heard of that and think it's more of an investment strategy, but it also applies to day trading as well. So the point of the trend continues the next day is if this stock closes like my example, that trend is high odds. Now, we can't guarantee anything in the markets, but we stack the odds in our favor. Odds are that stock that closed like that, that's where you're gonna see that gap down, okay? Where it closes at, say, $1 and opens at 70 cents or something, okay? So that trend is most likely to continue into the next day. So in our situation, we would never wanna buy a stock, a big spiker that closes weak on the day, fades in the close, or even gaps down into the close, because why would you wanna buy that if the odds state the trend is gonna continue the next day? What we wanna do is buy stocks like I drew here that closed at or around that high of the day. Now, it could kind of trickle a little bit lower, or it could even close strong. But when you're building that watch list, those are the three types of scenarios you want to look for. It could still fade, like trickle a little bit lower, but as long as it closes up here, it's on your watch for the next day. If it closes sideways, or if it runs into the close, you're going to avoid all the weak closes. Because going back to what I said a minute ago, we want to trade stocks that are most likely to have the bullish trend continue into the next day. Now, what we're looking for are all of the criteria we're looking for on any trade, okay? We want high volume, catalysts, hot sectors, all those box checkers. If you've never watched my box checker video, it's a term I use. It's kind of a shorthand for the main criteria that we look for. Make sure to subscribe to the channel, go through the feed. I probably got 5 box checker videos over there, but we want all of those criteria in play to stack the odds in our favor as well. So next thing, we want this type of price action. A nice thing to also have, and I'll denote that in blue here, has to close above VWAP, okay? So I want the blue line, think of that as VWAP. Even if this stock meets those other 3 criteria, if it can't close at or above VWAP, also kick it off your list, okay? We're using VWAP to determine particularly where the big buyers, the big sellers are, where the control is. Yet again, VWAP is a #1 day trading indicator. I probably got 10 videos on the channel talking about VWAP, but we want that type of price action coupled with a close above VWAP. Now, how do we actually trade these? We're going to key off of several different areas. One we love is that basically break of day 1 high. So where that stock opens really doesn't matter, okay? That's the great thing about being able to wait for this to set up. We don't really care if it gaps down, opens sideways, even gaps up a little bit. We're keying off of the day 1 high, and then that's our entry. Then we're gonna build our trade plan around that, manage our risk, extrapolate our goal. Yet again, channel has a bunch of videos on trade plans. Now, my favorite way to trade these is an acronym, W.A.R.G. Maybe you've heard me say that. Stands for weak open, red to green. This is the absolute, by far, best pattern on these, because when that stock gaps down and then starts the base, we can now use that basing area where it settled down, started to consolidate, started to grind sideways as our risk area, and then we use our entry when that stock flips from red on the day to green on the day. So now we have an entry and a stop loss, so we have a trade plan. It's a beautiful thing. We can now properly position ourselves. We know, because remember, each one of these charts will vary. Maybe in this situation, there's 20 cents of risk, so you're buying 1,000 shares. Maybe it's a lower price stock with a tighter range and you're risking 5 cents a share. Maybe you're buying 10,000 shares, but it allows you to manage your risk and position size properly depending on how far away that basing area is from the red to green line. So that's the absolute best way. Now, I love that break of day 1 high. If you've got my ebook, by the way, all of these patterns broke down. This video is really pulled from the ebook. We love these entries on these pushes. Now, the other thing, as I mentioned, is a lot of these are going to gap down, never go green, never break the day high. So that's the beauty of that, is we're allowing this trade to actually set up instead of just seeing a big gainer the day before. I'm sure you've heard it from me. You've probably heard it from Tim Sykes. Always focus on the big gainers. 100% true, but how do you approach them? We avoid the ones that gap down and die. We look for the ones that either gap down and base or break the day 1 high. Now, the couple things I want you to avoid, if and it does happen fairly frequently, you get that big gap up. Like say it closed I'll use this line as a scenario, and that stock just gaps up huge and takes off. Don't chase those, okay? Because what's going to happen there is so many people, and they're smart, okay, the smart people that respected what I said earlier, that the trend tends to continue on day two. So you've got a lot of people that are loading up on these stocks on that strong close. Well, what's that going to induce the next day? If the gap up comes, you're just going to see a absolute onslaught of selling, because it's just smart trading by the guys that took them into the close the day before. They get a 10, 20, 30, 40, 50% gap up. They're like, hey, ring the register, get me out. So if you chase those gap ups, all you're going to do is probably be buying their shares at the end of the day, okay? Now, good for them, but I don't want to buy their shares if they're unloading massive positions because they're ringing the register, because I'm going to buy their shares. There's going to be no buyers left except me, and I just got dumped on, okay? The other thing I want you to do is make sure you pay attention to volume. This is really critical. Now, all of these stocks invariably are going to trade less volume than day one, simply because there was so much interest on day one. I mean, flat out. We see these stocks trade up hundreds of million shares. Sometimes they break 1 billion shares. So don't be alarmed by the fact it's trading less volume on day two, but you really want to still be looking for float rotation and above the 60-day average. Because if this stock comes in the next day and matches these parameters and it's starting to do a week open red to green, but it's only trading a few 100,000 shares or something like that, that's going to be one you want to avoid, okay? So that being said, guys, if you miss that first move on day one, it's not a bad thing. I like to quote my buddy Jocko Willink and say good, okay? If you've watched the good video, it's probably got 1 billion views. By Jocko's got a short one, but every roadblock he runs into, he always says good. And I think it applies to this. Missed a big day runner, good. Now you can be prepared for the second leg. Now the gains aren't going to be as huge, but the reliability of this pattern is so much better. And you can approach it with a level head and a real plan, and ultimately focus on those strong closes. Ignore the ones that close weak. Look for high volume, clean breakouts that align on all 3 time frames: the intraday, the 2-month, the 1 year. And the crowd catches up late. Use that to your advantage. Now don't chase the gap ups like we talked about. Look for them to get shook out early and then join either that break of the day one high or the week open red to green. Use the chasers to your advantage. Let them do all the madness early in the day and join the trade late day.